Financial statements of a sole trader. Okay. So introduction. At the end of every accounting period, the business entity prepares a trading account and a profit or loss account to ascertain the profit or loss made during the accounting period. It is important to realize that the profit or loss account indicates the performance of the entity for a particular financial year. See Learning Unit 10. So basically prepayments and receivables, accruals of income and expenses, accrued expenses. So I want us to look at example 11.1. So basically this is accrued expenses. What is accrued expenses? These are expenses which has been incurred by entity but which have not yet been paid by the end of the accounting period. Example are salaries owing to staff, rent payable, insurance premium, accrued expenses shown as current liabilities. So when adjusting accruals and prepayments, it is necessary to identify the specific account to be adjusted, determine the outstanding amount or the prepaid amount, record the adjustment. So let's just look at example 11.1. Accrued expenses. The financial year end of John Sipe a panel beta ends 31 December. Sipe panel betas has a monthly rent of 250. The records of the entity show that rent was paid for 8 months during the financial year 31 December 20.8. Okay. Record the necessary adjustment and closing entry in the general journal of SIPE panel beaters. Post the journal entry to the general ledger. So basically now, Jessica, the financial year end, do you know what is the financial year end?
Yeah, like when the year of trading comes to an end and we're going to have to total the accounts and so forth.
Is it? And how many months is a financial period?
12 months normally.
Well done, well done. And then now they're saying that panel beaters monthly rent expenses is 250. So do you agree with me that for 12 months, it's going to be 250 times 12?
Correct, yes, I do.
So basically they're saying now that the records of the entity show that rent was paid only for 8 months during the financial year. So how many months is outstanding?
4 months is still outstanding.
So how much, what is the value?
1,000 rand.
So that will be 1,000 rand. And how did we calculate that?
250 times 12, and then that's 2,000. So the full year would have been 3,000. So that balance 1,000.
Well done. Well done. So basically how we got to this rent expense, we said 1,000, we said 250 times 4, which is 1,000. And then we need to accrue, adjusting for rent owing of 1,000. So the profit, so do you know what is a profit or loss account?
Yeah, that is where we're going to determine the companies, either whether they made a profit or whether they made a loss.
Yes, yes, yes. So a profit and loss is basically income less expenses account.
Okay.
So basically, you're right when you say it's that account whereby they're moving all the income and expenses to that account.
Okay.
To determine if they made a profit or loss. So in this case, can you see that closing transfer? They're moving the total rent, which is supposed to be 3,000, closing that account with 3,000 and debiting the profit and loss with the 3,000.
3,000. Okay.
So basically the rental expense now is 0 because the whole balance of 3,000 is been moved way to this profit and loss account.
Okay. Okay.
Can you see? So what's happening? The accrued expense will be 1,000 rand, which is that 250 times 4. So I'm gonna give you another example. So let's say electricity for 12 months is 12,000, and now it's the financial year end.
Yes.
So electricity every month we get a invoice. We get an invoice from Eskom. So in this example, we're just estimating that our electricity bill is, as the business, is 1,000 rand. So the financial period of this business is Jan to December.
Okay.
So as at December, we haven't received an invoice. So the invoice that we received is only for 11 months. So as at December, we haven't received that December invoice, and we're busy with our financial year end.
Okay.
So we need to now to accrue for the
1,000 rand.
yeah. So how much is it? It's gonna be
It's going to be
1,000
1,000
rand.
rand. That's outstanding.
So we're gonna debit electricity with 1,000 rand and credit.
Credit our accrued expenses with 1,000 rand.
Yes, yes.
And then
yes.
to profit and loss, we will have closed the full 12,000.
Yes.
Okay.
Yes. Yes. So let's look at the prepaid expense. The nature of certain expenses may compel the entity to pay for them in advance. Insurance premiums are good examples of such expenses. Prepaid expenses are current assets. So for example, what is it? Traxi Solutions paid 9,000 for insurance for January 20.8. This payment was for insurance. This was for insurance cover for 18 months. The financial year end of Traxi Solutions ends 31st December each year. Determine the amount that was prepaid for insurance.
The amount that was prepaid. Estimation running January, so 500 times 12. So 6,000 was prepaid. The whole 9,000. 9,000 and 6,000. 3,000.
So you're saying 3,000 is a prepayment.
Yeah, for the next year, I think.
Okay, let's do it.
Next year.
So let's just do it.
So you say 9,000 divided by 18. 500 times 12.
So basically now 9,000 was paid, okay? But the payments covers insurance for 18 months.
And the
Okay,
finance is 12 months.
so we're gonna say 9,000 divided by 18. So per month is 500. So we're gonna say 500 times
12
times 12 minus 9,000.
is 3,000.
So 3,000 is prepaid. 3,000, are you with me?
Yes.
3,000 is paid, is an expense that is paid in
Paid in advance.
advance.
Okay.
So we're gonna debit 3,000 and we're gonna credit the insurance amount. And then the expense that should be accounted for that accounting period is only 6,000. So that's why we're crediting insurance and taking it to the profit and loss account. So you can see on the general ledger that the insurance expense should be 6,000. This is the 6,000. And then 6,000 is been taken out of the insurance into the profit and loss. And the prepayment amount paid in advance, the expense paid in advance is this 3,000. Are you happy with this one?
Yes, yes.
And then accrued income. This is income earned by the entity in respect of service rendered, but for which no payment has been received. This is income earned by the entity in respect of service rendered, but for which payment has not been received. So the commission earned by bureau stores for selling newspapers and magazines was 12,500 for the year end 31 December. Excuse me. Bureau stores received 9,850 during the year. Record the necessary adjustments and the closing entry in the General Journal of Bureau Stores. Post the journal entries to the General Ledger of Bureau Stores. So commission earned for selling newspapers was 12,500. Bureau only received 9,850. So how much does Bureau still needs to receive?
2,650.
So you took 12,500
and minus 9,850.
Yes, you took the 2 years and you got to 2,650. So accrued income is 2,650. Income still needs to be received. And then commission income is 2,650. So in total, the company for the full financial period should have received 12,500. So we're gonna take take out commission income, the income out of this account and to the profit and loss account, which we're gonna credit with 12,500. And then the accrued income will have 2,650. So in this case, what's gonna happen, Jessica, when the payment is received? So now, because let's just see, the income earned in response, so commission earned for selling newspapers. So when they receive the money, what will be the entries?
The accrued income is then going to increase. No, decrease.
So if the money now comes into the bank account,
our bank account is increasing
of bureau stores, what will be the entries now?
I guess the bank account is going to increase with 2,650.
Right.
And our equity or our income account will also increase on the credit side. So a debit on the bank and a credit on the income, or, well, the profit and loss, I think.
Okay. So the entries will be, no, because now, remember now, let's just see, when I just go up a bit. So remember now what happens is bureau stores sold the newspaper and magazines for 12,500, but they did not receive the full amount.
Yes.
So when they receive the money, bank is going to be debited with 2,650. And accrued income is going to be credited with 2,650.
Credited. But here it shows that it's the balance carried down.
So remember now the accrued income is debited.
Okay.
Now we need to clear this account.
So
need
we
to-
put the balance carried down as well.
So basically this, the accrued income is saying accrued income has a debit balance of 2650. So this is the income due to the company. So,
Okay.
so this is the income that is due to the company. That's
Take increase.
so basically when we credit this account, we are settling this. So in inverted commas, this is sort of like a data account. There is money due to us that we still need to receive.
Okay.
So this will be some form of a data account. So remember, a data has a debit balance. When a customer pays, we're going to credit this account to reduce that data account.
Okay.
Are you with me?
Yes.
So this is going to affect an accrued income. What is accrued income? Accrued income is a current asset. So do you understand why this is not affecting our income? We already accounted for the income. We can, it's already accounted for. The only account that needs to be cleared is this account.
Okay.
We need to, by the payment coming in, is clearing this account, the accrued income.
I see.
It's basically clearing this accrued income.
Okay.
Okay, so income received in advance. Income received in advance is not yet earned, so it must be deducted from the total income to arrive at the correct income earned during the financial year. Income received in advance is shown as a current liability.
Okay.
So let's do this example. ABC Cash Stores sublets part of its premises for a monthly rental of 280. During the financial year end, 31 December, the tenant paid a total payment of 3,640.
Okay. Determine the amount that was received in advance. That is 280 is received in advance.
So now we want to see how much was paid in advance.
280. So the 280 was received in advance.
Definitely. So basically, the rent was paid for 13 months.
30 months, yeah.
$13 months was received instead of 12.
Yeah.
So the 1 month, is paid in, is received in advance.
Yes.
So let's see how. Yes, can you see? So basically, rental income 280 is going to be debited, and income received in advance. Income received in advance is going to be credited with 280. Rental income should have been for 12 months. the income of it. We should have received 3,360, but we received more. That's why we recording the 1 month as a rental income or income received in advance. So basically now we're clearing this account to the profit and loss account. So the profit and loss account is gonna be credited with 3360. So my question is, what's gonna happen? I'm gonna give you an example. In January, we don't receive rental income. What entries must we do in accounts?
So if we don't receive it,
Yeah, because remember, Jan.
you already paid. Yeah.
What?
Okay.
So remember, we received rental income in advance. So it was for 13 months. So it was for Jan to Jan.
Okay.
So in January the next year, what's gonna happen? What entries must we record?
Would we not then, because we already have that 280, won't we debit in our income received in advance account and credit profit and loss?
Very close. So the entry in January, because we already received that income in advance.
Yeah.
Okay? What we're gonna do, we're gonna credit rental income and we're gonna debit income received in advance.
Okay, cannot the profit and loss. Okay, I see.
You see, can you see?
Yes, yes, I understand.
Can you see? We're clearing now this account now. And then the 280 will be will credit profit and loss, and we will clear the rental income account with a 280 in Jan. And then consumable stores on hand. You might have wondered why items such as stationery are classified as expenses. Surely stationery has value. The reason it is regarded as an expense, not an asset, is because it is used up within the entity within 1 year. So if an entity was to sell stationery, it would be regarded as inventory. Since it would not be used up within the entity. So if an entity, let me just read that. If an entity was to sell stationery, it would have been regarded as inventory since it would not be used up within the entity. It would thus not be regarded as an expense, but inventory. Remember though that if you were to see a stationery account in a trial balance, it will always be classified as an expense. This represents stationery used during the current period. So consumable stores on hand. So example 11.5, excess traders bought stationery valued at 5,000 during the financial year end 31st December. This was recorded in the stationery account as an expense of 5,000. After doing a physical inventory count at year end, it was found that stationery valued at 1,000 was still unused. This means that the full 5,000 of stationery they have bought during the financial year have not been used up. If excess traders was to close the entity at this date, would it be able to sell the stationery on the shelves 1,000? The answer of this question is surely yes. For this reason, an adjustment of the stationery account is necessary. The unused stationery to the value of 1,000 rand is regarded as a current asset. Record the necessary adjustment and closing entry in the General Journal of Excess Traders. Post the journal entries to the General Ledger of Excess Traders. So basically the 1,000, let me just see. So the unused stationery of the value of 1,000 is regarded as a current asset. So it's a consumable store on hand. So we will debit the 1,000 and credit stationery. So the stationery, which is an expense, is only the 4,000. So stationery, the 4,000 will be taken out to the profit and loss, and consumable stores on hand will be the 1,000. Are you with me, Jessica?
I am.
Okay, let's just do credit losses and allowance for credit losses. An entity which grants credit to its customers runs the risk of having some of those customers not paying their debts. So if it is expected that the amount due will not be paid by a customer, then this amount must be removed from the debtor's account. The amount written off is disclosed as an expense in the profit and loss account. Accounting entries for credit loss. So when debt is written off, the customer's individual account in the debtor's subsidiary ledger, and then also the debtor's control account in the general ledger is credited. The amount is debited to the credit losses account as an expense, which flows off to the profit and loss account. So example 11.6. On the 1st of January 20.8, REC Transport had the following debtors on its list of debtors. So the data, they've got Cargent 250, that's owing REC Transport, and Tango owed REC Transport 185. So on the 31st of August 20.8, it was decided to write off debts off as irrecoverable, since it was expected that this amount will not be paid. The financial year end is the 31st of December. Record the necessary adjustment and closing entry in the General Journal of REC Transport. Post the journal entry to the General Ledger. So basically, this is what's happening. The total debt of REC Transport is 250 plus 185. So basically 250 plus 185. So 435 is owed to REC Transport. So on the 31st, it was decided that to write off debt as irrecoverable. So basically, there will be an expense called credit loss of 435 because they're writing off these two debtors as debtors who will not be able to pay their accounts. So they're writing their accounts off. So basically now we're going to take out the 435 out of the credit losses account and to the profit and loss account. The recognition of the credit loss is done in the general ledger by debiting credit loss and crediting debtors control account. It is also important to update the individual accounts of the data with a transaction where the credit losses are recognized. This is done by the subsidiary ledger where the individual debtors accounts will be credited with credit losses. So this is definitely what's really happening. The credit losses account The credit losses account, it's now been cleared. The balance is being taken to the profit and loss account. And now the debtors control account is going to be credited with 435. Okay, allowance for credit losses. So in order to show the correct amount of total debtors on the statement of financial position, it is prudent for the entity to estimate how much of the debt owed to it will be paid. The reason for this is that in practice, the debtors often default on their payments. In line with the accounting concept of prudence, entities should make allowance for debts they expect will not be paid and adjust accounts accordingly. The entity should assess whether any events have occurred that may result in non-payment of the outstanding amounts. In such events, if such events have occurred, the recoverable debtors balance should be estimated and allowance of credit losses account should be created to reduce the carrying amount of the debtors account to its recoverable amount. Since the recoverable debtors balance fluctuate annually, the allowance for credit losses account will also fluctuate annually. It is important to understand that the allowance for credit losses account is normally used when non-payment are expected, but it is difficult to identify the specific debtors who will default on their payments. So accounting entries. When an allowance for credit losses is created or increased, the credit losses account is debited and allowance for credit losses account credited. In the statement of financial position, the allowance for credit loss is disclosed by deducting it from debtors control balance. It is shown as part of trade and other receivables. Because it is an allowance for credit losses that is made, there will be no entry for any individual debtors account. So example 11.7, allowance for credit losses. Twenty stores commenced business on the 1st of January 20.6. The entity serves both cash and credit customers. It was determined that the allowance for credit losses account should amount to 2,325 at 31 December. Debtors control as at 31st of December amount to 15,500. Record the necessary adjustment and closing entry in the General Journal of 20 stores. So, do you understand what is an allowance for credit losses?
Yeah.
So basically, the company needs to make adjustments for possible debtors who will not, yes, who will not be able to pay the company. So the entries normally is, so in this case, we're gonna debit credit loss with 2,325, and we're gonna credit allowance for credit losses 2,325. So basically this account is part of trade and other receivables. So this balance will reduce our trade, our debtors control balance. So basically now this credit losses will be cleared to take into the profit and loss account. So allowance for credit losses will be 2,325. Our credit losses account will be closed off to the profit and loss account. Increasing the allowance for credit losses account. It is now 1 year later, and 20 stores is at the end of the next financial year, 31st December 20.7. The balance on the debtors control account is 20,000. 20 stores determined that the allowance for credit losses account should amount to 3,000 as at 31st of December. So this is, let me just see. So 20 stores, 20 stores. So, no, excuse me. So basically the first example, our allowance for credit losses was is 2,325. So on the second example, they're saying 20 stores determine that the allowance for credit losses account should be 3,000 as at the 31st of December. So do you understand what that means? Jessica?
Yes, yes.
Do you understand what that means? So basically, if the end of December 20.6, our balance for credit losses is 2,325. And the company is expecting that by December 20.7, this should be 3,000. So how much must the credit loss be for December?
2325. Was it the
No.
difference between 3,000 and this?
Yes.
Okay.
Yes. So already there is this. So basically they are saying now they want the allowance now to be 3,000. So it will have to increase by 675.
Okay.
So the allowance now has increased by 675 to make it 3,000. So the six is, so now it's increasing. It's now we're gonna move the 675 to the profit and loss account. So the next example, so basically this, I wanna show you this example, 11.8. So 11.8 was increasing the allowance for credit losses. Do you understand why that was the increase? Because the allowance as at December 20.6, the allowance for credit losses was 2,325. Now they said in December 20.7. So can you see why they're saying it was increasing the credit loss? Because it moved from 2,325 to 3,000. To 3,000. So now the next example, they're saying decreasing of the allowance for credit losses. So those services had the following balances. So allowance for credit losses was 4,210. Debtors control was 38,160. So come to service determine that the allowance for credit losses account should amount to 3,816 at December. So what will be the adjustment? Are you with me, Jessica? What will be the adjustment? So
The
if
adjustment will be 33,950.
so you're saying 33,950. So basically you take 4,210 minus 3,816. 816. So the adjustment will be 394.
394, yes.
So how did I get to 394? I said
The
already the
allowance
existing.
less what we catered for.
Yes, yes, yes. So basically now allowance for credit loss is going to be debited with 394. Credit losses is going to be credited with 394. So can you see now the balance is going to be taken to the profit and loss. So the allowance now has decreased to 38. The credit losses, because also it has decreased, is moved to the profit and loss. So we now on depreciation. When an entity buys an asset which is intended to be used in the entity for more than one financial year, that asset is described as a non-current asset. Through their continuous use, these non-current assets lose value through wear and tear. This loss of value is known as depreciation. Depreciation is calculated for each accounting period using an agreed method of depreciation. The original cost of the asset is adjusted based on the depreciation calculated. The adjusted value of the asset is shown in the books as the carrying amount. So the adjusted value of the asset is shown in the books as a carrying amount. So meaning the adjusted value would be cost of the asset minus accumulated depreciation will equal your carrying amount. Depreciation is an expense which allows for the matching of the original cost of the non-current asset against income generated by the asset. So if the asset was used for only a part of the accounting period, the depreciation is calculated on the number of months for which the asset was used. So methods of calculating depreciation. So there is the straight line method. So an entity can use several methods of depreciation to determine the amount of depreciation to be written off on a specific non-current asset. Some of the commonly used methods are the straight line method and the reducing balance method. What is the straight line method? According to this method, depreciation is calculated on the cost of the asset using a predetermined depreciation rate. The depreciation rate would be given as a certain percentage, e.g. 15% per annum if non-current asset was bought for 4,000 and its depreciation rate was given at 10% per annum, the annual depreciation will be. So basically this example is saying depreciation was bought for 4,000 and the rate was 10%. So 4,000 times 10% equals to 400, which is the depreciation. Where the economic useful life of the asset can be estimated with certainty, this can be used to determine the depreciation rate. Assume that an asset was bought for 5,000 and it was expected that economic life of 5 years, the annual depreciation will be 5,000 divided by 5, which will be 5,000 divided by 5. So basically, assume that asset was bought for 5,000 with an expected useful life. So basically, in this example, you can always also say 5,000 times 20%. So when you say, Jessica, 5,000 times 20%, how much do you get?
1,000.
So how did I get 20%? Do you know how did I get 20%?
The 20%, wouldn't you have said it's the 100? Yeah. Just go look that. Maybe we said 1,000 divided by 5,000 times.
Yes, you're correct. So I said 100 divided by 5.
Okay.
Yeah, you're correct. So if the asset is expected to have some value after the economic life, this value is known as the residual value. To calculate depreciation, the residual value must first be deducted from the cost of the asset before the depreciation rate is applied. Calculation of annual depreciation. C2 stores bought office equipment for 10,000 on the 1st of January. It was estimated that this asset will have a residual value of 2,000 after its economic life. Calculate annual depreciation of office equipment. So we're going to say 10,000 minus the 2,000, then, so the 2,000 is that, what is it? The residual value. So it's going to be 10,000 So we're going to say 10,000.
Less the residual value.
Yes, and we get 8,000 times 10%. Times 10%. Are you with me?
Yes, I am.
So it's either 10% or you're going to say divided by 10 years.
Yeah.
So it's the depreciation per annum is what? Is 800. So what is the depreciation per month?
800 divided by 12. 66 per month.
Is how much?
It's that 800 divided by 12 months.
And it's going to be?
66.66.
Well done. Well done, Jessica. And then let's do the reducing balance method. So basically, can you see, I want you, after we do the reducing balance method, I want you to see the difference between the two. Based on this method, the annual depreciation is calculated on the carrying amount of the asset. So before we do the reducing balance method, I just want to show you something on this one. Just want to show you this on using the straight line method. So in this example, remember, they said that depreciation is 800 per annum. So basically now, how do you record this? How do you record this in the books? So basically it's gonna be debit, depreciation, and credit So basically, this is the entry for that depreciation that we calculated. So there will be an account called depreciation, debit 800, and there will be an account credit accumulated of 800. So what's going to happen now if we record this in the statement of financial position? So in the statement of financial, so statement of profit and loss. So in the statement of profit and loss, there will be depreciation debited with 800 for the year ended. And then in the statement of financial position, so in the statement of financial position, so this was, what was it? Let's see. So this was office equipment. So office equipment was 10,000. So there will be office equipment accumulated depreciation of office equipment so the carrying value or the book value. Carrying value or book value will be, what will be the carrying value or book value of this asset?
Will be 9,200.
Which is 10,000 minus
800.
800. It's 9,200. Can you see the recording? If you've gotten a depreciation as a calculating it, this is how you record it. So this will be part of your profit and loss, 800, and this will form part of the statement of financial position, the equipment and the accumulated.
And on the statement of financial position, does that go under the asset portion, the office equipment?
It will go under non-current
Non-current assets.
asset.
Okay,
will
as
go-
part of property, plant and equipment or what?
Yes,
Okay.
yes, PPE, yes, yes. So normally in a practical company, a company will have something that's called an asset register. So there will be an asset register that a company keeps to keep record of the depreciation. So let's do the reducing balance. So we are on example 11.11. Calculating of depreciation using the reducing balance method. ABK Metal Works bought machine for 60,000 on the 1st of March 20.7. It was decided to depreciate the asset by 15% per annum using the reducing balance method. The financial year of the entity ends the 31st of December. Calculate annual depreciation of the machine for the financial year end 31st December 20.8 and 20.9. So 20.7, let me just see what information. Annual metal works bought machine for 60,000 on the 1st of March, and it was decided to depreciate the asset by 15% per annum using the reducing balance method. The financial year end ends 37th December. So the cost of the asset is 60,000, which was bought the 1st of March. Okay. All right. So carrying amount times depreciation. So basically cost minus, so this is the difference between reducing balance method and straight line. When you calculate depreciation using the reducing balance, it's normally cost price minus accumulated times rate. In the straight line method, it's only cost price. Let's go to the
Cost price minus the residual value.
It's normally, so the straight line is normally cost
minus the percentage or times the percentage.
Yes, times the rate. But if an example like this one says they give you the residual
Then we're
value.
gonna have to subtract it.
Yes,
Okay.
but normally when you
Normally
calculate,
it isn't, right? Normally it isn't like that. It's just off the cost.
yeah. So normally it's cost price times rate.
Yeah, it's getting a little confused because in 1502, they didn't talk about residual value on the depreciation, the straight line method.
Yes, because why? This is just an example. They're just adding it to this example, but a straight line is just cost price times
Less
rate.
the value. Okay. Okay.
Because in the straight line method is cost price times rate.
Yes.
But if an example has a residual value, you
Then you
need to
take it into consideration.
yes,
Okay.
yes, yes. And reducing balance method, it's cost price minus accumulated multiplied by rate. So in this case, because cost price is here, it's given, it's 60,000, can you see? And this asset was only bought on the 1st of March 20.7. The depreciation is calculated in 20.7. So can you see that there is nothing previously? We didn't, this is the first year. So because it was bought on the 1st of March, so March, so we're going to depreciate it end of December, which is our financial year end. So we're going to depreciate it for how many months?
10
March.
months.
Yes, yes, because we only bought it 1st of March, not in January. So it's not the full 12 months.
So that's why we say that multiplied by 10 divided by 12.
Yes, yes. So we're going to say 60,000 minus 0 times 15% times 10 divided by 12. equals to 7,500. So the machine was bought on the 1st of March 20.7, which means for the first financial year,
It's only used for 10 months.
For 10 months. And as such, the depreciation needs to be apportioned for only the months that it was used. So now we need to do depreciation for the year 20.8. So do you agree with me now for the
We
year?
already have an amount accumulated depreciation now.
So for the year 20.7 is debit depreciation 7,500, credit accumulated 7,500. Are you with me? For the 20 point. So for the 20.7, it's debit depreciation 7,500, and we've got a credit of accumulated depreciation 7,500. The machine was okay. So now we're calculating depreciation for 20.8. Do you agree with me that cost price, what is the formula for calculating reducing balance method? Is cost price
minus accumulated depreciation
times rate. So because the last financial period, we calculated depreciation. So we're going to say 60,000 minus 7.5 times 15% times 12 divided by 12. So we're going to say 60,000 minus 7.5 times 15% times 12 divided by 12. Then you get your depreciation, which is debit depreciation 7,875, credit accumulated depreciation 7,825. But as it, I'm gonna, as at the end of December 20.8, accumulated depreciation is 7,500 plus
7,875,
which is
15,375.
Yes. Now we're calculating depreciation for the year 20.9, which is 60,000 minus minus depreciation for 20.7, which is 7,500, minus depreciation for 20.8, which is 7,875, times 15% times 12 divided by 12 equals to
6,693.
What is the accumulated depreciation for the end of December 20.9? It is 15375 plus
22,068.
How much is it for the end of
22,068 rand, 0.75 cents.
So you took 15,375
plus
plus
6693.
So let me just look. It's 15375 plus 6693.75 22068.75. Am I right?
Yep, I got the same amount.
Okay. Accounting entries for depreciation. Depreciation is an expense account which is closed off to the profit or loss account at the end of the year. Accumulated depreciation. This account holds all the depreciation written off on a particular asset until the asset is completely written off, sold or scrapped. You have learned that income and liability account have a credit balances. Since accumulated depreciation account represents the credit side of an asset account, it must also have a credit balance. Accumulated depreciation is regarded as a negative asset. The annual depreciation calculated is shown as an expense in the profit or loss account, and the carrying amount is reported as a non-current asset. Recording of depreciation and accumulated depreciation. Milking Products bought a plant for 120,000 on the 1st of April 20.7. They decided to depreciate the plant at 10% per annum using the reducing balance method. Record the above information in the general ledger of Milking Products for the year ended 31st December. Annual depreciation is 120,000 minus 0 because this is the first time we're calculating the depreciation because the asset was bought 1st April. So 1st April to 31st December, it's 9 months.
9 months. Yeah.
So it's 120. So what is the formula for calculating the reducing balance method? It's cost price minus accumulated depreciation multiplied by the rate. Okay, so in this case is 120,000 minus 0 times 10% times 9 divided by 12 equals to 9,000. Annual depreciation for the financial year ended December 20.8. So depreciation for 20.8 is 120,000 minus 9,000 times 10% equals to 11,100. So what is the general journal not shown? So basically now depreciation is what? Is for the year ended December 20.8 is 11,100. The accumulated depreciation is 9,000 plus 11,100, which is, let's just see, which is, let's just calculate. It is 9,000
2,100
plus 11,100. It is 2,100. And we're closing off this depreciation to the profit and loss account. So summary of the flow. So now we're going to be doing a comprehensive example. On the 28th of February 20.1, the following trial balance was extracted from the general ledger of Mumbai Traders, a general merchant that is not registered as a VAT vendor. So basically this is the trial balance and this is the adjustment, year-end adjustment. Prepare the following in respect of Bombay Traders. General journal with regards to adjustments, general journal with regards to closing entries. Post the general journal entries to the relevant ledger accounts. Close or balance this account at year end. So basically the first one is an outstanding debt of 300 is irrecoverable and must be written off. What is the interest there? A debt is been written off.
So we're going to debit our credit losses And debit credit loss and credit our profit and loss.
So basically now, this is a debt that's been written off. There must be an expense and there must be an asset. So the expense is credit losses and the asset is debtors control. So basically it's gonna be debit credit losses, the expense, and credit debtors control. The allowance for credit losses must be adjusted to 708. So let's just see on the trial balance if there is an allowance for credit losses. So the trial balance has 600. Ne? So we need to adjust that to 708. So how much must we adjust this for?
108.
Yes, yes, well done. So credit loss is going to, so did we increase or decrease the credit loss?
We increased it.
Yes,
Yes,
we increased because
it was
initially,
600, then it was 708.
yes. So now we're gonna debit credit loss and credit allowance for credit loss. Okay, number C, depreciation must be provided as follows. Equipment 10% per annum, straight line, and vehicle 20% according to diminishing balance method. Reducing balance method and reducing balance method and diminishing balance method is the same thing.
Reducing and okay, yes, yeah.
It's the same thing. So they can either say in a question, calculate this asset using the diminishing balance method or the reducing balance method. So we need to calculate this equipment at 10%. So let's see what is the equipment. So the cost price is 70,000.
So it's going to be 70,000 times 10%.
10%, which is 7,000. So we're gonna debit depreciation with 7,000, credit accumulated with 7,000. And then what is the accumulated for vehicles? So vehicles, we're gonna take 80,000.
Less than 39040.
Yes. So we're
and
gonna
then times
say,
it by 20%.
yes. So we're gonna say
1,000.
Did they say what is it, 20%?
Yeah, I think it was 20%.
I'm getting 8. I'm getting 8192.
8192.
So you take, let me go up to the TB. You're gonna take 80,000.
Oh, 80,000. Is 39,040. Okay, I used 70,000. Oops.
Oh,
8192.
yes. And can you see that they've taken the
They
7?
totaled it.
Yes, yes, to
for
get to
depreciation.
15,192. Okay.
Okay.
Number D, the terms of the mortgage loan provides for interest on the loan to be calculated at a rate of 15% per annum on the outstanding amount of the loan at the end of the financial year. Interest payable in the first week of January for the following year. The loan was originally granted for the entity by Capital Bank Limited on the 2nd of Jan. Now we need to calculate the interest. We need to calculate the interest. So the amount is of the mortgage is what 120,000. It's 120,000. What is the rate? 120,000, and what is the rate? It's 15%. So the annual interest is what?
18,000.
Yes, yes. So you're gonna debit interest of mortgage
And credit your expense.
and credit your accrued expenses. So it's adjustment for interest payable. Okay, let's see. The next one is a van granted an unsecured loan to the entity on the 1st of September. According to the terms of the loan agreement, interest at 9% per annum will be granted and is payable in Jan of every year. The total amount of the loan will be repaid in full on the 30th of June. According to the terms of the loan, interest at 9% per annum will be charged and is payable January every year. Okay, so let's just see the loan. So how much is the rate? The 9% of the loan.
What is the loan?
Isn't it 30,000?
Long-term loan, okay.
Is it what, 9%?
Yes. That is 2,700.
The answer is not, it's 900. You forgot the 4
Oh,
months.
the amount of months. Okay, so it was
Forgot
in
the
September,
months.
October, November. 4 months. 900. Okay, there we go.
And then it's going to be interest on loan, 900. Accrued expense, 900. Okay, let's look at advertising expense include an amount of 400, which was prepaid for Jan 20.2. So where's the advertising amount?
One.
An advertising expense includes an amount of 400, which was prepaid for January. So prepaid expense 400, advertising 400. So basically the advertising amount should be 7,000. Should be 7,000. Do you agree with me?
Yes, I do.
Okay. So let's look at amount paid for water and electricity excludes an amount of 2,300 still payable for December. So this is an accrued expense. So 2,300 accrued expense, 2,300. Number H, a commission of 1,200 for selling newspaper at cash registers is still payable for the whole year. A commission of 1,250. So this is accrued income. Adjusting for commission income not yet received, yes. This is accrued income. An inventory account of packaging material at 31st December showed that there was still 700 worth of material on hand. So this is what consumable stores on hand. Yes, 700, and packaging material 700. Number J, insurance premium for 3,600 was paid on the 1st of Jan for the following 12 months. So we've got a 3,300. That is a prepaid expense. Can you see?
Yes.
Got a 300 prepaid expense. So debit prepaid expense and credit insurance, because the insurance for the current financial period should be in total should be 3,000. The entity rented out an office in their building to a lawyer for 2,000 per month. The lawyer took occupation on the 1st of December and paid an amount of 4,000, being the rent for December and January. So this is what income received in advance of 2,000.
Yes.
So now we need to post this to the profit and loss account. Can you see that these accounts are being taken to the profit and loss account? And these two are taken to the trading account. So the sales and cost of sales are taken to the trading account to determine gross profit or gross loss. Expenses are closed off to the profit and loss account to determine profit or loss. So these, you'll see these are taken to the trading account. Can you see? They're taken to the trading account. So now, after that, we need to generate a general ledger. So can you see that the general ledger, let me just see, what is the capital account? So the capital account has an opening balance of what? Of 250. So 250, they had a drawings of 7860. So now the balance. So can you see what's happening in this capital account? So basically in this capital account is the opening balance as per the trial balance, is the drawings balance as per the trial balance, and this is the profit amount. And this gives us a capital of 419,200. Let me just see. So can you see where this balance coming from? This is going to the capital account. Can you see?
Yes, I see.
So is this a profit or is this a loss?
Profit.
This is a profit, eh? This is a profit. Why are we saying it's a profit? Because the credit side is bigger than the debit side. So basically now This comes from the trial balance. This comes from the opening trial balance. This comes from the trial balance. And this comes from that profit and loss account. And this is the new balance of the capital account, which is 419,200. The drawings account, there's nothing because this balance has moved out of this to the capital account. So there is nil in this account. So the debtors control account, this comes from the trial balance, and this comes from the general journal, that credit loss. And then the new balance is 17,700. Accrued expense is all those journals. This comes from the general journal. So now we have a accrued expense of 21,200. Prepaid expense, this all comes from the general journal. So remember these ones from the general journal.
Yes.
And these ones also from the
Yes.
general journal, okay? And then income received in advance, remember, yes, from the rental income from the general journal. Accrued income also from the general journal. There's also from the general journal. And the accumulated depreciation, this comes from the trial balance. This comes from the general journal, and the closing balance is 28,000. This comes from the trial balance. This comes from the general journal. This comes from the trial balance and the general journal, and this is the closing balance. Now, what is the balance on the sales account? What is the balance of the sales account?
That 595 from there.
It's how much? What is the balance of the sales account?
The balance is there, 595.
The balance is zero. Balance is zero.
It balances out, okay.
Why am I saying it's zero? This was the opening balance from the trial balance, and this account was moved to the trading account. Are you with me?
I'm just looking at the trial balance again. Just give me a second. Okay, yes, I see.
Are you with me?
Yes.
Can you see? So the
Yes.
balance of the sales account, the opening balance comes from the trial balance. And then we move this balance to the trading account. So in that way, it closed this account.
Of this account, okay.
It closed this account. And then what is the balance on this cost of sales account?
It's also zero.
Yes, yes, well done. Well done.
Getting somewhere today.
That's good. And what is the balance of the advertising account?
It's zero also.
Yes, yes, well done. And the bank charges?
It's zero, we closed it off, zero for telephone expenses.
Yes, water, electricity, zero.
Everything's closed
salaries,
zero.
they all they all been closed off to the profit
and loss account.
to the profit and loss account. So all the expenses are being moved there. So they all, so can you see the cost? Can you see the sales and the cost of sales?
Yes.
They are here. And then they are moved. So out of this trading account, they are also moved to the profit and loss.
Account.
Here they are. Here they are. And then all the expenses are here, bringing it to a profit of 240,060. 240,060. Now, I want us to look at the financial statements. So we'll do this comprehensive example number 2. So Mimosa dealers reached at the end of the first financial year, the 30 September, the following trial balance was extracted from the accounting records on that date. So this is the trial balance. So basically they're saying, prepare the statement of profit and loss and other comprehensive income of Mimosa dealers for the year ended 30 September 20.3. And this trial balance is for 30 September 20.3. Okay. Prepare statement of financial position for Mimosa dealers as at the 30th of September. Prepare statement of changes in equity for the year ended 30 September. If it is assumed that 250,000 capital was invested on the 1st of October 20.2, calculate the percentage return of the first year on capital invested. If this entity is using a constant markup on the cost for all trading inventory sold, determine the percentage of the markup. If Mimosa dealers moved into the building from which they trade, calculate the monthly rental payment if all payment has been made up to date. So just looking at this, can you tell me did the company make a profit or loss?
I'm just looking at the trial balance. I'll answer now. So if you just look at the statement. I am going to go with a profit.
Are you guessing or are you calculating?
Give me 1 second.
Because you can calculate, eh?
Yeah, we will say sale. Minus the cost of sales. Yep, it would be a profit.
Of how much?
Of 192,500. If I say sales minus cost of sales. So 382,500 minus 190.
So basically, when you're looking at the trial balance, this is how you determine if the company has made a profit or a loss. So you're gonna take the sales.
Yeah.
So just looking at the trial balance. So you're gonna take the sales plus this interest plus this 360 and minus everything that's here. Minus this.
360 minus 160. Oh, minus all of that.
Mm.
Oh, okay. Yeah, we still made a profit.
How much is the profit?
52,220.
Okay, I'm just calculating on my side. I'll tell you how much I'm getting. Much profit. I'm getting 52,220. How much are you getting? I'm getting 52,220. How much are you getting, Jessica?
Sorry, I was on mute. 52,220 is also what I got.
Oh, okay. All right. All right, let's just check here. Can you see? Can you see? There it is. So this is how the layout of the statement of profit and loss. Can you see? So is the revenue. How do they get this revenue? So basically they took this.
Plus that.
So they took 382,500, 12,000. Let's just see. Revenue, we do see this 382,500, ne? And then I think they minused sales return, eh?
Yeah, I see they're minusing. And then they're
then
minusing at 840.
which is the settlement discount granted. So they're minusing the settlement discount and also the sales return.
And it still came to the same amount.
Can you see? Then they got to the sales, and then cost of sales is 190,000
360.
minus the settlement discount received. And then we go to the gross profit. And then the other income is this one. And then they said distribution, administration, and other expenses. So basically, I think this here
is the total of that.
Yeah, total of this. And then let's see, this is the profit. Yeah, can you see? So I'm saying to you, before even doing this
Before
format,
even doing that, we can calculate it.
you can calculating it, but just looking at just the nominal account section.
Imagine.
Just looking at the nominal account section, you can determine if the company made a profit or loss. So now let's look at the statement of financial position. So property plant is 48,000. Let's look at the trial balance.
The equipment for it.
So there's only equipment, eh?
Yes.
So it is 48,000 because there's only equipment, and fixed deposit. Let's look at the fixed deposit. It's 100,000. Fixed deposit is 100,000. So non-current asset in total is 148,000. So basically it's 48,000 plus 100,000. It's 148. So inventory, let's look at inventory. So inventory also so inventory So inventory, can you see that inventory also from the trial balance? Trade, trade and other receivables is status control. Cash and cash equivalent is bank, which is 127,500. So the total assets is 430. And let's look at capital. How do they get to capital? So capital, they took the balance from the trial balance. So they took the balance from the trial balance, which is 250,000 minus drawings. minus drawings, and then plus the profit. Are you getting that?
Yes. Drawings, where's drawings?
So
What's the profit?
and long-term loan is the long-term borrowings is what? Can you see? Only from the trial balance is 120,000. Can you see?
Yes.
And then trade and other payables, it's creditors control, which is 30,210. So this is from the trial balance. So always when you do a statement of financial position, this needs to balance. Your total assets must always equals to your total equity and liability. Are you with me?
I am.
So this must always balance. So let's just look at the statement of changes in equity. Oh, so the statement of changes in equity is this, what we just did. Can you look at number 3? Prepare a statement of changes in equity for the year ended 30 September, which is what? The opening of capital account, total the profit, and then less drawings. And then you get to that. Let's look at number 4. If it is assumed that 250,000 capital was invested 1st of October, calculate the percentage return for the first year of capital invested. Let's see how it's calculated. So they took the profit divided by the capital, so it's 20.89%. Can you see? So the percentage return for the first year. So the return of the owner of capital invested for the first year is 20. The percentage, did you see how much is it? It's 20.89. How did they calculate that?
Oh, the 52 to 20.
Which is the profit divided by capital balance.
Divided by 250. Oh, okay. Back up the same thing.
And then number 5 is if this entity is using a constant markup on cost for all the trading inventory sold, determine the percentage of the markup. So basically the percentage of the markup will be equals to gross profit divided by cost of sales times 100. So gross profit is 175.20 divided by cost of sales 189,640 times 100. So basically number 5, the question is if this entity is using constant markup on cost for all trading inventory sold, determine the percentage markup. So the percentage markup, they've taken gross profit. Where is it? So they've taken gross profit divided by cost of sales times 100, which is 89.92. And then number 6 is if Mimosa dealers moved into the building from which they trade on the 1st of October, calculate the monthly rent payment if all payment has been made. So 36,000 divided by 12. So let's just see how much is the rental. So basically here they're asking how much is the monthly rental. Let's just see. So if Mimosa dealers moved into the building from which they traded on the 1st of October, calculate the monthly rate payment. Oh, so they wanted the monthly rate payment, which is what? 36,000 divided by
12.
divided by 12.
That gives us 3,000.
So basically, especially when you're doing this, it's so important for you, like the way they did it, this is so important that revenue and cost of sales will be taken to the trading account. All of this is part of the profit or loss account, which especially after calculating the profit and loss account, it will affect your statement of changes in equity, which is balance at the beginning of the financial year, the capital contributed, total contribution for the year, less drawings, and then balance at the end. So it's so important for you to understand the structure here for the statement of changes in equity. Just see for the statement of, so for if you want to do a statement of financial position, this is the format. So at the end, your total asset, which is this, must always equal your total equity and liabilities. So basically, when I look at these questions here, question number 4 to 6, they're quite tricky. Is it me?
No, it is.
They're
If you
quite,
don't read
and
properly, you can miss it.
but can you see that when you look at the answer, they're quite simple.
Really.
When you look at the answer, they're quite simple. But the way they ask it, it's like,
Yeah.
this is so, when you look at it, this is so advanced. Like,
I promise when I was doing it alone, I'm like, what on earth is going on? And
this
now
is
that we're
so
doing it, I'm like,
advanced.
you're joking.
Hey, it's like, what is this? Because now they're asking percentage of return, which is just what? Which is just the profit divided by the capital. Can you see? It's just the profit divided by the capital. And the other one is just taking the markup is gross profit divided by cost of sales, just to get the markup. And this one is even worse, eh? You can even get it wrong, this one, the last one. This one you can get it wrong. The question should be, what is the monthly rent? But they went and say, if.
And in all these extra words,
You
and then
know
you panic.
why?
And the problem is you're so limited for time in the actual assessment that you panic and then you don't think.
It's true. It's so true. So basically what I can advise you with, you need to, especially when they're giving you the trial balance, apply yourself, especially when it comes to these questions here. Let me just, there's a question that I saw now that I think most people can get it wrong. This one here. Allowance for credit losses must be adjusted to 708. So this one I can see somebody saying credit losses debit 708, credit debtors control 7.8, 708. So I can see somebody getting it wrong because they don't see adjusted to.
Meaning it's increasing now.
Yes, it can increase or decrease, but you need to look at adjusted to. That's the main thing. Adjusted to.
I think I can go do assessment 3 now.
Adjusted to, Jessica. Adjusted to. So basically, what I can tell you, especially when they're giving you the trial balance, use it. Use it. Because here you were only able to adjust this because what? You went up and
There
looked
was
at
an
the
amount on the trial balance here.
Yes, use the trial balance. Use the trial balance.
There's a reason it's there.
Yes, use your trial balance. Use your trial balance. Use your trial balance. That will help you. And as you say, you are pressed with time. So when you're pressed with time, it's important to understand. It's important to understand what you do, what's happening. So the more you understand it, the what do you mean? The quicker it is for you to finish.
Yeah.
The quicker for you to finish. The quicker for you to finish if you understand.
Yeah, if you understand all the concepts, it's easier when you're doing, when it's combined. Thank you so much.